Imagine waking up tomorrow morning and discovering that a market worth more than the entire US economy almost stopped working overnight. Not the stock market, not Bitcoin, not real estate, a market that most people have never even heard of, a market where governments borrow money, banks survive, hedge funds make enormous bets, and central banks quietly intervene whenever things go wrong, a market so large that it's measured not in billion, not even trillions, but well over $100 trillion. And if it freezes, the effects don't stay on Wall Street. They show up in your mortgage, your savings account, your job, and sometimes even the price of groceries. The strange part, almost nobody talks about it, because unlike stocks, this market isn't exciting. It doesn't trend on social media. It doesn't create overnight millionaires. It's simply the plumbing of the global financial system. And just like plumbing, you only notice it when something breaks. Today we're talking about the bond market, the trillion-dollar market almost nobody understands, and why it quietly controls far more of the economy than most people realize. To understand why bonds matter, forget finance for a moment. Imagine your friend wants to open a restaurant. They need $1 million. You could become a business partner and own part of the restaurant. That's basically buying stock. Or you could simply lend your friend $1 million with the promise they'll pay you back in 10 years, plus interest every year. That's a bond. You're not an owner. You're the lender. Simple enough. Now replace your friend with Apple, or the US government, or Japan, or Germany, or thousands of companies around the world. Suddenly you've built one of the biggest financial markets ever created. Everyday governments need money. Companies need money. Cities need money. Instead of asking banks for everything, many of them simply issue. If the answer becomes maybe, interest rates rise. If the answer becomes no, the system can unravel frighteningly fast. This is where things become much more interesting. Take the United States. The US government owes tens of trillions of dollars. That sounds terrifying. Yet investors around the world continue lending America more money. Why? Because compared to almost every alternative, US government debt is considered one of the safest assets on earth. Think about how strange that is. The country with one of the largest debts in history is also one of the easiest borrowers in history. Finance is full of little ironies like that. Safety isn't always about having no debt. Sometimes it's about convincing everyone you'll always pay it back. That's why governments care so much about credibility. Lose trust, and borrowing suddenly becomes much more expensive. Now, let's look at something most people never see. Suppose a government issues a bond paying 3% interest. A year later, new bonds suddenly offer 5%. Which bond would investors rather own? Obviously the new one. That means older bonds paying only 3% become less attractive. Their market price falls. Nothing about the government changed. Nothing exploded. Nothing dramatic happened. Just interest rates moved. Yet trillions of dollars in bond values quietly shifted. This is why headlines saying bond prices fell actually matter. They aren't just numbers on a screen. They're changing the value of assets held by banks, pension funds, insurance companies, and investment funds across the world. Now imagine you're a bank. You bought billions of dollars worth of government bonds when interest rates were incredibly low. For years, everything looked perfect. Then, inflation arrives. Central banks begin raising interest rates faster than they have in decades. Suddenly, the bonds sitting on your balance sheet lose enormous amounts of value. You haven't sold them, but on paper, you've lost billions. If customers never panic, you might survive. But if everyone suddenly wants their money back, now you have to sell those bonds at a loss. That's exactly the kind of pressure that helped trigger several banking failures in 2023. The problem wasn't mysterious derivatives. It wasn't cryptocurrency. It was something as boring as government bonds. Sometimes boring things create the biggest crises. The bond market also quietly controls something else. Almost every interest rate you care about. Mortgage rates, car loans, student loans, business loans, corporate borrowing, even many savings accounts. They're all connected until months later, everyone realizes those tiny cracks were the beginning of something much larger. That's why professional investors spend so much time watching the bond market. Not because it's exciting, because it's often the first place where the financial system reveals what it's really thinking. The stock market tells you what investors hope. The bond market tells you what investors fear. And history has a habit of rewarding the market that's paying closer attention. The next time you hear someone say the bond market moved today, remember, they're not talking about some obscure corner of finance. They're talking about the invisible foundation underneath almost every modern economy. A market so important that when it works, nobody notices. And when it doesn't, everyone eventually does. The question isn't whether the bond market matters. The real question is this. If the world's financial system depends on an ever-growing mountain of debt, what happens when investors finally decide they want less of it?